Welcome to the video. Today we are going beyond the 401k to decide where your next high-yield dollar should go. If you are already maxing your 401k, you might be wondering whether to pour extra money into a taxable brokerage account. Instead, we will map a smarter order. Use a Roth IRA, including the Backdoor Roth strategy if you are a high earner. Fully fund your health savings account. Maintain healthy short-term cash reserves and a high-yield savings account for near-term goals. And only then allocate excess to a taxable brokerage in low-cost diversified funds. We will also examine whether a $2 million number by age 50 is sufficient and what it actually takes to retire early with confidence. Here is our agenda. First, we will explain why prioritizing a Roth account can beat taxable over the long term. Next, we will walk through the Backdoor Roth IRA steps. Then, we will unlock the power of the HSA's triple tax advantage. After that, we will address near-term cash needs using a high-yield savings account. We will also visualize the priority order and tax buckets with diagrams. We will then challenge the early retirement target with realistic math. Finally, we will include 2 quick quizzes to test your understanding before we wrap up with actionable takeaways. This content is for educational purposes only and does not constitute financial, tax, or legal advice. Your situation is unique and may involve variables such as state taxes, income phase-outs, rental property treatment, and healthcare needs that require professional guidance. Tax laws and contribution limits change, so verify current IRS limits and rules. Before executing strategies like the Backdoor Roth IRA or using an HSA for long-term investing, consult a CPA or fiduciary planner and confirm that your actions align with your risk tolerance, time horizon, and cash flow needs. Let's start with the Roth IRA, which deserves top priority after your 401k. The Roth offers tax-free growth and tax-free withdrawals in retirement, so the earlier you fund it, the more decades your gains can compound without future taxation. If your income exceeds the Roth IRA direct contribution limits, you can still often access this benefit via the Backdoor Roth IRA, which we will explain shortly. Both spouses can each fund a Roth IRA, effectively doubling your annual tax-free contributions. Inside the Roth, focus on low-cost, diversified funds like a total market index or a balanced allocation that aligns with your risk tolerance. This prioritization typically beats adding more to a taxable brokerage account prematurely, because taxable accounts expose dividends and capital gains to ongoing taxes, especially over long horizons. Here are the Backdoor Roth IRA steps. Open both a traditional IRA and a Roth IRA at your brokerage. Contribute non-deductible after-tax dollars to the traditional IRA. Then convert those funds to your Roth IRA, preferably soon after funding to minimize any taxable growth. Critically, watch the pro rata rule. If you hold any pre-tax IRA balances on December 31st, your conversion may be partially taxable. To avoid that, consider rolling pre-tax IRA balances into an active employer 401k before you do the backdoor. Keep precise records and file IRS Form 8606 to report your non-deductible basis and the conversion. Repeat annually. Each spouse can perform this process independently, effectively doubling your Roth capacity. Once converted, invest in low-cost, diversified funds consistent with your goals and risk tolerance. This flowchart maps your next dollar decision once you have addressed the 401k. If you have capacity, first direct it to the Roth IRA or Backdoor Roth. Next, fund the HSA if eligible. Then ensure your near-term goals are covered with a high-yield savings account. Finally, channel remaining surplus into a taxable brokerage with low-cost index ETFs. The right side emphasizes best practices, including periodic rebalancing and tax-efficient behavior, such as favoring ETFs for lower capital gains distributions and placing less tax-efficient assets in tax-advantaged accounts. Automating the sequence minimizes missed months and keeps your plan on track. The HSA is often called a triple tax-advantaged account because contributions are typically pre-tax or tax-deductible, growth is tax-free, and withdrawals for qualified medical expenses are also tax-free. After you build a modest cash buffer for near-term health costs, consider investing your HSA for long-term growth if your plan allows it. Save receipts for qualified medical expenses you pay out of pocket today so that you can reimburse yourself tax-free in the future, even years later. For early retirement planning, the HSA can act as a potent supplemental account. After age 65, non-medical HSA withdrawals behave like traditional IRA withdrawals. They are taxable as income, but avoid the early withdrawal penalty. This versatility gives you multiple levers in retirement. Aggressive long-term investing must be balanced with near-term realities. Maintain a dedicated emergency fund, often 6 to 12 months of essential expenses, and add rental property reserves to cover vacancies, maintenance, and unexpected repairs. For any goals within 1 to 3 years, such as purchasing a reliable vehicle or providing support to family, hold that money in a high-yield savings account. Only invest beyond these reserves, since markets can be volatile in short windows. Use automatic transfers into both the HYSA and your investment accounts so you consistently fund goals without relying on manual decisions month to month. This pie chart illustrates a sample allocation across tax buckets. The optimal split varies, but balancing pre-tax, Roth, and taxable accounts gives you flexibility to manage taxes each year in retirement. Roth funds and HSA dollars used for qualified medical expenses are highly tax efficient. Meanwhile, taxable brokerage accounts supply liquidity and the option to harvest gains or losses strategically. Over time, rebalance contributions to maintain a mix that fits your evolving tax situation and anticipated retirement income sources. Let's test whether $2 million by age 50 is robust when you start with $200,000 at age 29. Over 21 years, at 5% nominal return, that $200,000 grows to approximately $556,000. To reach $2 million, you would need to contribute around $3,233 per month. To reach $3 million, about $5,473 per month. At 7%, the starting balance grows to roughly $774,000. Then you would need about $2,136 per month for $2 million, or $3,881 per month for $3 million. At 9%, the starting balance grows to roughly $1,096,000. Contributions to reach $2 million drop to about $1,207 per month, or $2,542 per month for $3 million. These figures are simplified, rounded, and exclude taxes, fees, employer matches, and changes in limits. Market returns are uncertain. Use planning software or a professional to run Monte Carlo simulations and consider sequence of returns risk, especially for early retirement horizons that can span 40 years or more. This sequence diagram will depict each actor and step in the backdoor Roth process. The investor opens both a traditional IRA and a Roth IRA. The investor contributes non-deductible dollars to the traditional IRA, establishing after-tax basis. The custodian records the basis and executes the conversion to the Roth IRA upon the investor's request. The Internal Revenue Service evaluates the pro rata rule based on pre-tax IRA balances on December 31st. If pre-tax balances exist, the conversion may be partially taxable. To mitigate this, the investor can roll any pre-tax IRA funds into an employer 401k before conversion. The investor files Form 8606 to document basis and the conversion. This cycle can be repeated annually to continue building Roth balances. Quiz time. Question: which feature makes a health savings account uniquely powerful compared to most other accounts? Option A: only contributions are tax-free. Option B: only withdrawals are tax-free. Option C: contributions, growth, and qualified withdrawals can all be tax-free. Option D: it has no annual contribution limits. You may pause the video now to think about the answer. We will discuss the correct answer in the next section of the video. The correct answer is C. The HSA's triple tax advantage means contributions can be pre-tax or tax-deductible, growth is tax-free, and withdrawals for qualified medical expenses are tax-free. This unique combination makes the HSA one of the most powerful accounts for tax-efficient long-term planning, especially when you invest the balance and save receipts for later reimbursement. Second quiz. Question: after maxing your 401k, what is the recommended next step for most high earners based on this framework? Option A: increase taxable brokerage immediately. Option B: fund a Roth IRA or use the Backdoor Roth, then fund the HSA, then build HYSA for near-term goals, and only then fund taxable. Option C: buy individual stocks on margin in taxable. Option D: keep all funds in checking to stay liquid. You may pause the video now to think about the answer. We will reveal the answer in the next section. The correct answer is B. Prioritizing the Roth IRA or Backdoor Roth, then the HSA, then short-term cash in a high-yield savings account ensures you capture powerful tax benefits and preserve liquidity for upcoming expenses. Only after those buckets are funded should you allocate to a taxable brokerage, where you can focus on low-cost, diversified index ETFs. Let's compare Roth and HSA contributions to taxable brokerage. Roth IRA and HSA funds provide significant long-term tax advantages. Roth growth and qualified withdrawals are tax-free, while HSA contributions, growth, and qualified medical withdrawals can be entirely tax-free. They are shielded from the drag of ongoing taxation on dividends and realized gains, which compounds the benefit over decades. The trade-off is annual contribution limits and some eligibility requirements. By contrast, a taxable brokerage offers unlimited contributions and immediate flexibility for any goal, but dividends and realized gains are taxable, which can reduce net returns. Techniques like using ETF share classes and tax loss harvesting can improve taxable efficiency, but they generally cannot match the intrinsic tax shield of Roth and HSA accounts. Therefore, it is usually smart to fund Roth and HSA first, then use taxables for remaining surplus. Here are the key takeaways. Follow the priority order of 401k, Roth IRA, or Backdoor Roth, HSA, high-yield savings for near-term goals, and then taxable brokerage. Inside accounts, use low-cost diversified funds and automate contributions with periodic rebalancing. Treat the HSA as a long-term asset by investing it and saving receipts for strategic reimbursements. Keep money for 1 to 3 year goals in a high-yield savings account. For early retirement, consider that $2 million may be insufficient for a 4-decade horizon. Model various return assumptions and withdrawal rates. Finally, consult a professional and verify current IRS rules and contribution limits. To wrap up, when you have capital beyond your 401k, prioritize funding the Roth IRA, using a backdoor if necessary, before aggressively adding to taxable. Fully utilize the HSA if eligible, investing it for the long run, and saving receipts. Keep cash for near-term goals in a high-yield savings account, not in the market. Finally, pressure test your early retirement target with realistic math, and consider whether higher ongoing contributions are needed to secure a durable plan. This approach makes each extra dollar work harder for your future. Thanks for watching. If this was helpful, please like the video, share it with a friend who is planning for early retirement, and subscribe for more practical wealth building strategies. Tell us in the comments what your next dollar move will be and what topics you want covered next.